Hi, my name is John Palmer, Senior Vice President and Head of Real Estate Strategies for Westwood. I wanted to take a couple minutes to share my thoughts on the REIT market for the month of December and the full year 2025. But as usual, I'll preface my REIT industry comments with some quick observations about the macro environment. While December was a bit of a weaker month as far as markets are concerned, overall, 2025 was a very strong year for market participants. For the full calendar year, the S&P 500 index finished up 17.9% and the Nasdaq finished up 21.2%. Investment grade credit was up 7.3% and high yield did even better at 8.5%. We'll go deeper into the REIT performance a little later in the video. On the economic side, we did receive some positive news in December. First, towards the end of the month, the Q3 GDP numbers came in at a surprising 4.3% clip, driven by strong consumer spending, increased exports, and higher government outlays. Next, the Fed decided to once again cut interest rates by 25 basis points at their December meeting, lowering the target range for the federal funds rate to 3.5 to 3.75%. This marked the third interest rate cut in a row. Chairman Powell indicated that the cuts reflect an effort to provide support for a softening labor market, though the minutes revealed division among officials about future rate moves. And while we have not yet received the formal announcement, it does appear that President Trump is going to make his choice for the next chairman of the Fed in the coming weeks. On the negative side, the labor market remains very uncertain. The official U.S. unemployment rate for November was 4.6%, a slight increase from September's 4.4% level, marking the highest level of unemployment since September 2021, with 7.8 million people unemployed currently. Lastly, let's turn to inflation. The U.S. inflation rate for November came in at 2.7% year over year, down from the 3% number in September, with core CPI, which excludes food and energy, at 2.6%. This decline beat analyst expectations, which were around 3.1%, and showed cooling price pressures, though some economists cautioned the data was potentially skewed by the recent government shutdown. With that macro commentary behind us, let's move on specifically to real estate. On the first slide, we show the 10-year Treasury chart for the full year 2025. As you can see, the 10-year started the year at 4.57% and ended the year at 4.17%. So the 10-year yield came down 40 basis points during the year. Switching to REITs on the next chart, you'll see the calendar year performance for the MSCI US REIT Index. Clearly, the month of April was the most volatile part of the year given the Liberation Day tariff announcement, but the index generally rebounded for the remainder of the year. For the full year performance, the RMZ started 2025 at 1306 and ended the year at 1291. So from a price perspective, the index was actually down 1.2% for the year. But when you factor in dividends, the RMZ registered a total return of positive 2.95% for 2025. Next, I thought it would be helpful to put the 2025 REIT performance in context with the broader market. On the next chart, I have broken out the S&P 500 into its 11 GIC sectors. As you can see, the REITs in the S&P 500 produced the worst return by a sector in 2025, and I think all market participants are hoping a reversion to the mean trade materializes in the coming year. On the next chart, we highlight the December REIT market performance by property sectors. December was a weaker month for REITs, with 10 property sectors negative for the month and 7 sectors producing positive returns. Leading the pack were timber, apartments, resi mortgage REITs, and regional malls, while healthcare, office, self-storage, and manufactured housing REITs lagged for the month. On the next slide, we compare property sector returns for the full calendar year 2025. On the left, you can see that healthcare and resi mortgage REITs significantly outperformed in 2025, but we also saw strong performance from industrial REITs, regional malls, and net lease REITs, whereas data centers, office, single-family rentals, timber, and self-storage generated strong underperformance in 2025. Lastly, I thought it would be helpful to show the change in valuations over the year. As you can see on the last slide, implied cap rates, for the most part, have remained fairly steady throughout 2025. However, the noticeable sectors would be data centers and specialty REITs, which have seen cap rates widen a fair amount, while healthcare and industrial REITs have seen meaningful cap rate compression. But the overall implied cap rate for the REIT market continues to sit in the mid sixes, which still remains a little wide to long-term historical averages. As always, thank you for your time. If you have any other questions, feel free to reach out directly to Westwood. I look forward to sharing additional updates with you in the future.